Walk me through some of your main calls for next year.
Main thing is that we expect some acceleration in growth. I would say led by the US, where we're about half a percentage point above consensus. Consensus view is growth slows to 1.8%. Recession risk is pretty high. The consensus there's a Bloomberg poll, the Reuters poll, 33 to 35%. Our view is that growth next year is going to be 2.3 on average, and we actually see a sequential pickup from where we are at the moment, basically because of a reduction in the impact from trade. Trade, we think, is currently subtracting nearly half a percentage point. We think that diminishes if there is a phase one deal and effectively a truce. And we think there's going to be some boost from financial conditions. Financial conditions have already eased a lot. That boost is basically in the pipeline.
We have a chart that kind of shows financial conditions and how they've been getting looser and looser. When is that impulse truly felt? Like where in the timeline and where has it felt the most?
Well, I think we're seeing it in some areas. So by our estimates, financial conditions were subtracting about 3/4 of a percentage point from growth early this year after the big tightening in the fourth quarter. And that's turning to a half percentage point boost by early next year. And we're, most of the way there. We can see it in some areas. The best example is housing, which was quite weak in 2018, early 2019, and where we've seen a pretty good rebound in areas like new home sales and home builder confidence.
What I feel like a lot of market participants are trying to figure out is we might have growth that on an absolute level is better here in the US, but that the higher beta for growth could be in Europe or different emerging markets. How do you view it?
I think that's, in emerging markets, I think it's a very mixed bag.
Okay.
I mean, you've got some places where you should see a pretty sizable acceleration. I mean, partly because it's a very low base. Latin America would fall into that category. I think India falls into that category. But then there are some places where I think it's sort of more sideways or even a little bit slower. China would be in that category for us. We have somewhat lower growth there next year than this year. Europe, I think you could see a pretty decent acceleration, and you're starting to see that in some of the surveys out of Germany from very low levels. Germany has been very weak, but a sequential acceleration of 3/4 of a percentage point seems reasonable.
Makes a difference. And it might make a substantial difference when the base is already so low.
Yes, I mean, I think they need it more in some sense.
Fair.
When you're starting from, I mean, in Germany, contraction and very slow growth in the euro area as a whole, you really pretty desperate for an acceleration. I think we're starting to see some of that.
And then you also sort of a deep dive into central bank rate cuts, and you have a great chart in your note that talks about how many cuts that we've seen this year and just how the pace of cuts is reminiscent of like 10 years ago. So it's like, who's left? Like, what does this tell you?
It's just a very big shift from rate hikes in 2018. I mean, especially in the US, but also in various other places, smaller DM economies. To rate cuts in a very short period of time. So that's the most rapid sort of turnaround since the crisis. The extent of the cuts, the aggressiveness of the cuts is still nowhere close to what we saw in 2008, early 2009, but it's just a very sharp shift. And that, I think, is obviously the main reason for the improvement in financial conditions. We have seen 3 rate cuts from the Fed when markets were pricing 1 or 2 hikes a year ago. So that's a pretty sizable turnaround, and that has very much shown up in financial conditions.
You also mentioned that the single biggest event of next year is going to likely be the U.S. elections, and you're also looking at profit margins that come under pressure. How do you look at it? Yeah,
so the fundamental, away from the election, the fundamental trend that we're seeing is a lot of labor market tightening. The unemployment rate is down to 3.5% in the US. And we are seeing, contrary to what's sometimes expressed, pretty sizable increases in wages. Overall wages are increasing sort of 3 to 3.5%. If you look at the lower income part of the income distribution, we're in the sort of 4 to 4.5% range. And because inflation is still pretty subdued, 2% give or take, depending on whether you look at CPI or PCE, that is starting to put upward pressure on unit labor costs and is weighing on profit margins to some degree. And I think that's probably going to intensify as we go forward. So I think despite the fact that we expect a pretty good growth environment and generally a pretty market-friendly backdrop, this is one area where things might not work out as well as people might be hoping. That's just the economics. And there's political uncertainty, of course, around tax policy, and the risks there are tilted to the downside. We're not going to get additional tax cuts probably, but we could get tax increases depending on what happens in November.
So we got CPI out earlier, we got average hourly earnings, so like all kind of in line. Then we have the Fed later today, the ECB tomorrow. What would be your question for Jay Powell today at the presser looking ahead to 2020?
I think it's actually hard to come up with really new insights. I mean, my expectation is that the Fed doesn't really want to send a new signal. I think they're very comfortably on hold. They're pretty far away from additional cuts, at least under our expectation for how the economy does. But hikes are also basically off the table, with core PCEs still clearly below 2%. So, I think getting a sense of just how wide that interval is probably is the most interesting issue, but I think it's pretty wide. My expectation would be that the answers to most of these questions are not going to be hugely surprising. So that's kind of the broad strategy. There are some sort of smaller, more detailed questions around, what happens to the dot plot, what has happened to the divisions within the committee, how is the view of the sustainable unemployment rate evolving? It's still 4.2% in the Fed projections, even though the unemployment rate is 3.5 and inflation is still below the target.